This is Current Yield, Grant's interest rate observer of the air. I'm Jim Grant, and with me, as always, is Evan Lorenz, the great deputy editor of Grant's. We are going to talk today with Eric Cinnamond, and I am persuaded that we will be recording because Henry is at the controls as usual, and all things are set to go. So, Evan, I want to begin by observing to you that the Wall Street Journal appears to have bugged the Office of Grant's Interest Rate Observer. And I say this because this morning, the Wall Street Journal published something that you yourself wrote last evening.
If flattery is the sincerest form of imitation, or if imitation is the sincerest form of flattery, they gave us a great compliment.
Yeah. Well, tell our listeners what they copied and what legal steps we are taking to prevent this from happening again. Go on.
Well, I think we're in line to sue Rupert Murdoch after some other prominent figures in America. The story is essentially the Fed is actually controlling interest rates through a facility that actually exacerbates bank runs. So prior to the housing bust in 2007 through 2009, the Fed would actually nudge interest rates by buying or selling short-term treasuries in order to impact the rate that banks would lend their excess reserves to one another, either up or down. This worked well in the decade ending 2007 when excess reserves averaged 1.7 billion with a B. However, this system broke down over the course of easy monetary policy, and by 2013, when the Fed was in the midst of its third round of quantitative easing, excess reserves, topped $2 trillion. So the Fed introduced the RRP, or the Reverse Repurchase Facility. In the RRP, the Fed actually borrows against its gargantuan securities portfolio in order to set a floor under rates. The idea being, if you're a money market fund and you can actually lend to the Fed, which has a printing press and therefore is not going to, renege on its loan, then you're not going to lend to somebody else who doesn't have a printing press at a lower rate. And using this, the Fed was able to raise interest rates to, I think, 4.83% as we're going to press, from 8 basis points at the end of 2021. The only problem is money that gets locked into the RRP is, for all intents and purposes, locked off from the financial system. So let's think of a bank run without the RRP. If you, a depositor at Silicon Valley Bank, were worried about Silicon Valley Bank, you might take your deposits to JP Morgan. In that case, it's bad for the California lender, but overall bank deposits are changing. Or you might go off and buy a treasury saying, I don't want to take any bank risk whatsoever. Now, in that case, you would take deposits out of the system, but the person who sold you those treasuries would actually get your deposits and probably deposit them in another bank. It really wouldn't lead to a net change in kind of the funding system for the banking market. However, with the RRP, if you take your money and put it into a money market fund, and that money market fund then parks at the Fed, that money is locked off from the entire banking system. So in order to control rates, the Fed has actually created a system that encourages bank runs at times of crisis.
Well done, Fed. That's part of the Fed's powerful tools, is it not?
Yeah, as both the arsonist and firefighter.
Yeah, a dual mandate. One of these days, we're going to have Jay Powell on this program. I have been, he is a most unsatisfying sparring partner. He never raises his hands. I don't think I've ever been jabbed by Jay Powell, but goodness knows we've landed some fine hooks and straight right hands and combinations all over the Federal Open Market Committee, but they pretend not to notice, which is, I must say, a little bit discouraging. However, not unlike the Palm Valley Capital Fund, we are at Grants. We're patient, we're opportunistic, we're disciplined, we're focused on absolute returns, and we are bloody-minded. And I think the last descriptor especially pertains to our special guest today, Eric Cinnamond, who is one of 3 founders of this fund that most unusually seeks out good businesses trading at reasonable prices and invest in them for the long run. Have you ever heard about this before?
It's an intriguing idea. I think it might just work if somebody give it a...
I don't know. It sounds good. Anyway, Eric, welcome.
Thank you so much for having me. It's an honor. I've been following you since the early 90s.
Never mind the years. Never mind the years.
This is great.
Yeah. So tell the listeners, if you would please, Eric Cinnamond, what Palm Valley Capital Management does and how long you've been doing it, and with what level of success?
Well, we are an absolute return strategy that focuses on small cap stocks. And what that means is we are trying to achieve an attractive absolute return over a full market cycle. And to do that, since I've been running this strategy or have been in the industry, we've been in periods of rotating asset bubbles. So we've had extraordinary heights of valuation. And then during the bust, we've had very attractive valuations. So during these periods, we've had to achieve our goals, had to hold large positions in cash, T-bills, And then in other periods, we've had to get invested quickly as the cycles end. So for us, just as you introduced us, we're very flexible, opportunistic, and extremely different. The investment management industry has, since I started in, I guess, 1993, really transformed into, passive, obviously, index centric and relative investing. So the absolute return mindset, don't lose money, make money, of course, but let's try not to lose money first and foremost. Uh, that has kind of gone away as people have lost assets, jobs, funds. Some have passed away. So we're the three of us. Jamie Wiggins, Frank Martin, and myself. We've formed Palm Valley to try to keep the flame lit of absolute return investing, and so far so good. We're pretty happy with how things have gone so far.
Well, that sounds a little diffident to me, if I may say so. So you started in what year?
Well, the fund was launched in April 2019. The firm in 2018. So we're young. We're all about 4 years now. We launched in 18 with the thought being that this has been one of the most extraordinary market cycles in history. Small cap valuations have never been more expensive, and we think on the this cycle concludes, we believe strongly that we're going to see some very attractive opportunities.
But so you launched at the top with the least attractive opportunities, and nevertheless,
Yes.
in those
We were-
in those 4 years, or nice timing, by the way.
Yeah. So we launched when there was absolutely no value.
And those 4 years, you have generated what kind of returns compared to the monkeys so the competition that is riding the wave and is indifferent to valuation? What have you returned versus the S&P 500?
I'm not sure about the S&P. We don't follow the large caps very closely, but we've achieved I think 7.6% annually, which doesn't sound like a lot, but keep in mind the small caps are up about 4 to 6% depending on the benchmark you use. But what's interesting about that comparison, and again, we're absolute return, so we're not overly concerned about relative, but what's interesting about that is over that period, we've averaged being invested about 25%, so we're mid 70 range cash over that period. So we've taken considerably less risk to generate those type of returns. We went into COVID with a very large weight of cash because we weren't finding a lot of value. We were able to act decisively or quickly when valuations improved. During the COVID decline, small caps fell over 40%, able to get half of the strategy invested. Of course, the Fed came to the rescue. We're still a little bitter about that. We think we could have been fully invested, but they decided to buy corporate bonds, and I think that that day was kind of short-circuited our buy programs. So so we've done pretty well, and this is not the way we look at it. We launched this for the main event, and we definitely do not believe the declines we saw in 2020 or the recent volatility is the main event. We're up 600% from the cycle's lows, and these 20% drawdowns. I don't think that's how a cycle ends, but we could be wrong.
Could you talk to us about this current moment of the cycle? Because it seems to violate one of the truism in Wall Street, which is that you can have good prices or good news, but not both. Right now, we have we have extraordinarily high prices and extraordinarily bad news. Almost every time I open up the Bloomberg, it's job numbers are down. The ISMs for manufacturing or non-manufacturing services are disappointing. It seems like we have an economy that's slowing, and we're not having the compensatory factor of cheap stock prices.
No, you're right. So, one of the things we do is we have our opportunity set. It's a buy list of about 300 names, small cap stocks. We follow those very closely, and every quarter, we go through the calls and quarterly reports and get a very good feel for where we are in the economic and profit cycle, because we normalize profits. So knowing where you are in the profit cycle is very important. So with these 300 names, after every quarter, I think we get a pretty good feel for where we are in the economy. And I would say that things are slowing for sure. Uh, but you still have elevated asset prices. Home prices remain very high, especially over the past few years. You have pretty easy comps against COVID, which people forget that it's January, February of last year. So Q1 probably won't look too bad, especially with the weather. What we're really interested in is Q2 outlooks, which I think will be interesting and a little more telling. Where I think Q2 might give us a little more um, a better picture of what's going on. And then Q1 too, some of the drags will be tax refunds are going to be a little less. Inventory destocking will continue, and then the effect of accumulated inflation, which I think is a very important variable where we are in the profit cycle and consumer demand. That's going to continue to weigh on results. So I think you're right. The trend is lower. Um, Asset prices may remain inflated, and I think a lot of that has to do with the Federal Reserve and their powerful tools, which really is just money printing. If you don't behave, we're going to print money, and you better get in line. Um, so so you're right. Things are starting to, again, we've talked about this in some of our writings. Feels like 2007. We could see things rolling over.
Yeah, I would say, Eric, that in addition to the difficulties you cited, I would mention also the collapse in the rate of growth of the broadly defined money supply. It never in the post World War II era expanded so fast as it did in 2021, 22, and never in that same period has it collapsed at a rate of speed we've seen in the past year or so. So, that's one thing. And the other is the inverted yield curve. Short-term interest rates are higher than longer-term interest rates, which for many years has been a pretty reliable portent of macroeconomic trouble. And then you have the evidence of tightening credit within the banking system, which is not so hard to imagine because, of course, the banks are losing deposits and losing certainly confidence, as indeed are many of their depositors and would be borrowing customers. So Evan and I are on recession watch. Mr. Market himself seems to be rather more focused on the powerful tools of the Federal Reserve, which may or may not come to rescue.
Yeah, I agree with that. And I think, the last year, many of the opportunities we were seeing were from volatility created from higher interest rates. I think going forward, especially in Q2, possibly Q1, but I think definitely Q2, I think the next catalyst for opportunities within our opportunity set will be earnings, where there will be, margins are just so high. The COVID stimulus, the acid inflation that was created, the margins of many of the companies we're following are 40 to 50% above normalized levels. So I think as this earnings cycle unfolds, I think the next round of opportunity will be in earnings disappointments, which again we expect that to occur, if not in Q1, starting in Q2. So we're pretty optimistic. Now Q1 is going to be tricky because asset prices did stay elevated. Housing stabilized somewhat. So I don't see this like an '08 air pocket. I again view this more like an '07. The economy and profits are on watch.
So you've been in the investment industry for 30 years. After a decade and a half of easy monetary policy, I believe something like a third of all Russell 2000 companies are actually losing money. At the same time, you also have a large cohort of companies that are earning supernormal margins. How thin are the pickings when you kind of look at the universe that you hunt for stocks in, and how does that compare to the 30 years that you've been in the business?
That's a great question. So yeah, and I think Evan, now it's closer to 50% companies in Russell that are losing money. It's a very nasty benchmark. I wouldn't, if I know there's a lot of index huggers out there and people that buy ETFs, I would, personally, I would avoid Russell 2000. It's not exactly high quality. There's a lot of junk in there. But yeah, the our opportunity set, it's based on more mature businesses that have been through many cycles. They typically have gained market share throughout each cycle. There's something high quality about them. They tend to have better balance sheets because they're survivors. But one of the themes we've noticed over this cycle has been the sharp increase in corporate debt and leverage. And I would argue that our opportunity set, while it's still around 300 names, I think the quality on the balance sheets has declined over the past decade. There's many companies that have that once for generations had just pristine balance sheets. They were very proud of their balance sheets, and whether a new generation of management came in or just the pressure, that we get oftentimes, and apparently bankers have gotten to recently, is always you always have to do something, right? And I think the pressure of a cycle that's lasted 14 years has pressured many managers in companies that once had great balance sheets to capitulate, make large acquisitions. There's Gorman Rupp, Sybil's GRC. It's one of the market leaders in sewage pumps and construction pumps. They once had a fabulous balance sheet. Now it's full of debt due to an acquisition. Heartland Express, they broke my heart. I mean, when they acquired and levered, they went for many years with a debt-free balance sheet. Patterson UTI, PTEN, they are a land driller. I bought a big slug of them in the financial crisis of 2009. They had a great balance sheet. Today they have debt and a lot more equipment. And then you have the buybacks and dividends this cycle. You have the Big Lots of the world, the Hanes Brands, Scotts Miracle-Gro. These are all companies that bought back tremendous hundreds of millions of dollars of stock and paid out very attractive dividends. And now they find themselves in a pickle. They're having to refinance 4% debt. They're taking on 9% debt. And they are just inflexible now. And that's another wonderful thing about liquidity that we always appreciate running money, is having flexibility. But many of these companies with these balance sheets that have levered up, sometimes you only have one chance. You have one chance with the balance sheet, and then it takes you several years, if not a full cycle, to rebuild that balance sheet, improve that balance sheet. So many companies this cycle have, we believe, put their balance sheet in a very difficult position, especially for when the next recession hits.
What percentage invested is the Palm Valley Capital Fund?
As of last disclosure, we were only 20%.
And how does that stack up along the 4 years you've been operating?
We peaked at 95, and then in COVID, we got down to 50. But this strategy is...
So is 20 the record low then in investing? 20% of assets?
Well, at the very beginning, we were 95% cash.
Well, yeah, of course. But since inception, since after the initial, is 20% the low?
Yeah, we're 80% cash is very high.
so this is in that respect the least attractive market you have seen, at least recently, right?
Oh, this is the most expensive small cap market I've ever seen in my career.
This is after the 2022 pullback.
Yeah, right. I mean, small caps, the Russell 2000 got down to, 980, I believe, during COVID. We're now at 1750. So even though we've had a decline, small caps are down 20% last year, but they're nowhere near attractive levels. We keep track of the valuations on our possible buy list. And currently, the median enterprise value to EBIT is 18 times, which is extraordinary. And we usually don't get interested in a mundane, boring, mature small cap business 10 times or lower. So this cycle, we believe, is a cycle, if you want to normalize and revert margins to normal and valuations to normal. Small caps, there's absolutely no reason they could not get cut in half from here. I mean, absolutely no reason, just to get back to average. And that's why we launched. We obviously didn't launch to roll T-bills. So that's not fun.
Well,
we we launched the
T-bills at
strategy.
T-bills at
Yeah.
5% now. So
Well,
tell me,
a little more enjoyable now.
Yeah. So Eric, tell me about AUM, assets under management. What are they now? Have they grown? Are these investors of yours? Are they mindful of the fact that you didn't say it, but we will say it on your behalf, that you have outperformed a heresy for an absolute return manager, but you have done better than the relevant indices over these, call them 3 years, right? Getting past the inception year. So are you gaining assets, losing them? And if you're losing them, have you fired your public relations counsel yet?
Yeah, I think that might be me. So, yeah. So, when we started, it was just friends and family. We had about 5 million under management, and Jamie and I, by government standards, were living in poverty. but yeah, when we got on the platforms, that takes a long time. You have to have a lot of interest from advisors. But once we got on the platforms, we did get inflows, and they've been consistent. So the fund now is a little over 200 million, and then we have separate management accounts, a little over 30 million. So the firm is profitable. We're still small, but we're in a good place. We like our positioning. We like how the market's set up for us, and
No, you don't.
the clients we do have.
No,
I think thoroughly.
Eric, you do not like the way the market's set up for you. This is
I
the
do.
least attractive market you have ever seen. We've established that. Now,
Jim, it's so bad it's good.
let me get back to the critical question of whether you guys are making a living. Can you send your shirts out to the laundry, or are you still ironing them at home?
Oh, I'm definitely ironing.
All right. Okay. Just wanted
Well,
to
in
clarify
fact,
that.
I had last week I had 2 flat tires in my Nissan Armada, and I went to get them fixed, and he said, "Yeah, you must be driving down Ponte Vedra Beach Boulevard." I said, "Yeah, I am. How did you know that?" He said, "Well, there's so many tear downs, homes being torn down on Ponte Vedra Beach Boulevard, that there's nails and screws all along that street." So that's my new indicator of this cycle. Once I quit getting flat tires driving down Ponte Vedra Beach Boulevard, there'll be fewer tear downs, and the economy will be going towards a
Are we
recession.
talking about the phenomenon that I first noticed many years ago in the affluent regions of California? Are we talking about scrapers? A scraper is a house that used to be perfectly satisfactory
yeah, for
until
sure.
the latest upsurge in asset values, in which case it was put on the block and scraped to the ground to make room for something even more grandiose. Is that what we're talking about?
Oh, that's exactly what we're talking
Okay.
about. And in 2006, I went around with my camera, and back then you had a camera, you didn't have a phone, and I went and took pictures of all the condos being built in Jacksonville Beach. Um, and there were many. So I wanted to document the housing bubble. This time around, it's the scrapers, as you know, very nice homes being torn down and being replaced with 10 to $20 million homes. But there are nails now all over the road, and the tire business around here is booming. And in fact, after I replaced my tires, I went to look up Goodyear as a long idea, but it unfortunately has too much debt for us.
I advise you to see a lawyer. Anyway, go on there.
So a second ago, you pointed out that from the COVID lows, the Russell 2000 almost doubled. What's been driving this surge into to small caps? Because as you pointed out, something like half of the Russell companies are losing money. The other half are having margins at all-time highs, which any active manager should say, maybe there's some downside here. Is it retail investors? Is it passive? Have active investors lost their collective minds? What are you competing against, and what's driving the market?
I just think how money is allocated today, there's not a lot of bottom-up driven research or analysis in how the allocation goes. I think so many things are, traded in groups, and I think we have great advisors, so I don't want to, say they're doing this, but I think a lot of advisors that allocate a lot of money, they have certain software that looks back on history and how certain asset classes have performed and how they're correlated to one another. And then it shoots out this pie chart, this wonderful, beautiful pie chart that's in color, and they can put it on some nice paper and present it. But you have to have small caps, right? Because the performance, since 2009 has been very, very strong. And I think that the group trade, the asset allocators believe they have to have small caps. And for us, we're of the opinion that you don't have to have small caps. In fact, you don't have to have any small caps. And I think we've proven that by starting a small cap fund and not having small caps. So, but now we do have some. But yeah, I think it's just the group trade, the passive flows, and the really lack of bottom up research. I mean, think about bottom up research this cycle. If you did that, you've missed out on a lot of gains. If you've kind of been logical, rational, it's probably hurt you. And what happens in these type of cycles is the capital flows to who is willing to play along, right? And if you're a bottom up analyst and you're true to your discipline and doing valuation based investing, it's very hard to get discounts, very hard to justify small cap securities, especially the ones that are losing money. So you usually lose capital.
Yeah.
I mean, look at us. We're only $200 million. That's just nothing compared to the billions and billions of these typical small cap funds that are more tied to the benchmarks, and many have passive mandates.
Okay, Eric, I want to, everyone, of course, ought to invest today in the Palm Valley Capital Fund, PVCMX. But as they do, everyone should also log into the website and read the wonderful analysis and commentary. Click the commentary button, and you'll see some of the very fine, the best writing in the whole mutual fund, the whole canon of mutual fund commentary. It's right there on the Palm Valley Capital website. And I particularly like the Mr. Market's paddle, which is the current essay up, I think posted late in March. And I like it for many reasons. It's wry, it is wise, it is informative, and also take the gloves off and pounding the Fed. This is great. And you quote with particular gusto the Chairman Powell's comments on the November 2nd, 2022 press conference. So here's the money quote. A money quote is kind of a pun, and it's on Fed money quote.
I get it.
Okay. I didn't see eyes flash in appreciation. Okay. Quote, this is Powell. Again, if we over-tighten, and we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary, close quote. So the idea in this essay is that Mr. Market had in the past paddled those who sinned against the precepts or the laws of sound investing, prudence, circumspection, solidity, et cetera, et cetera. But now it's the opposite. They're going after Eric Cinnamon. They're going after the Dominican friars of value. Doesn't sound fair.
I mean, for those that believe in free markets and capitalism, to me, when I heard that, that is a threat. Right. I mean, that is threatening to those that believe in free markets, because he's saying if we get this wrong, which obviously they've gotten inflation very wrong, so who's to say they're not going to get something else wrong?
They also caused a bank run. They also they inflated asset prices. They've also made housing unaffordable. Their sins are not just limited.
I think we can say with a tip of the cap to the new baseball season, they touched all the bases. Touch them all, Chairman Powell.
But a pet peeve I have right now about the Fed is their devotion to reducing inflation without any mention of the inflation they've already created. One of the themes we're seeing right now with the companies we follow is how accumulated inflation is what's driving business and consumer decision making. Yeah. So it's not the consumer doesn't say, hey, inflation went from 8 to 6 or 5. Hey, let's go out and spend. They feel the accumulated weight of the inflation. And, I call it the Fed hit and run. Say you're at a stoplight and you see this guy driving at you, money's flying out his window, and he's driving recklessly. His monetary policy is reckless, rams into the back of your car, destroys 20% of the value of your car, and then takes off and says, don't worry, I'm going to try not to do it again. There's no discussion about, hey, fix my car. Yeah. And that's the Fed. They've reduced purchasing power by 20%.
William McChesney Martin, the Fed chairman from 1951 to about 1970, said at one point, one of his speeches in the mid-50s, when inflation was actually registering less than zero. Martin was on it was a century against inflation. Of course, he didn't do very well when it finally arrived. However, rhetorically, he was unmatched. And what he said in 1955, I think, was purchasing power lost to inflation. You never get it back.
You see that with the companies now. no one is willing to give back the gains they've made. Obviously labor is still pretty sticky, but you do not, once you get a price increase, you hold on to that for dear life. So it's going to be very hard to reverse the damage the Fed has done, and we don't expect it. So we believe part of the slowdown we're going to see, and we've already seen, especially on the consumer, is going to be due to the accumulated inflation, not necessarily. We agree inflation rate is going to fall, especially with the easy comps coming up. But that is not enough to bring back the consumer.
Eric, tell us some of the stocks that you do hold. What stocks pass muster in this most unvalue-laden market? What are you holding?
Well, we have about 15 stocks, so we do own some things, and unfortunately, to talk about those, some of them have worked out recently. So as far as discounts go,
like
many of these aren't at large discounts. But here's one of my favorite, and this is Jamie's idea. It's Lassonde Industries, and it's a fruit and beverage company, food and beverage, mainly fruit based, out of Canada. So one of the areas we're finding discounts are in closely held businesses because they're not in large part of the benchmarks. And then, our friends up north in Canada, they just don't seem to have the flows or the premiums on a lot of their stocks. But Lassonde is a very consistent business, generating very good revenue growth. It's a food beverage company. The issue they're having, and it's one of the themes we invested in over the last few quarters, is their costs were rising much quicker than their price increases. That is going to change over the next several quarters as the price increases catch up and their margins revert more to normal. Their normalized operating margins are closer to 7%. Right now, they're near 5%. So their earnings are in decline. They look depressed. But for us, as we normalize margins, we'll use the 7% to value it. And we value it at $150 Canadian dollars, and the stock now is at 102. With normalized free cash flow of around 80 million Canadian dollars, currently closer to 50 million. So sometimes you'll see us invest in things where margins are a little lower than where they should normalize, and eventually we believe will happen. But yeah, so I like Lassonde. We have a lot of interesting, really good balance sheets. I would say a theme of our strategy right now is good balance sheets. I think when this cycle ends, you're going to see a lot of the financial sins come home to roost, and we never want any of our companies to be at the mercy of a bank or the credit markets. So I think that's going to serve us well.
Eric, is there anything that you would like to hold forth about for just a couple more minutes we have not asked or haven't gotten into? No, you don't have to.
I think we're pretty good. I mean, we could talk about the strategy some, but that might be boring.
Have we touched on the Fed?
I can talk about the Fed all day.
Okay. So Eric Cinnamond, thank you for being with us. And I wish you, and I wish Jamie Wiggins, and I wish Frank Martin and all of your investors every good thing. And may there be many of those every good things. Henry, nice to be with you. Eric, ditto. And ladies and gentlemen, thank you for listening. This is Jim Grant on behalf of Current Yield, Grant's interest rate observer of the air.